So welcome to the fourth speaker in our speaker series. Today I'm pleased to welcome Andrew Garfield, a PR guru and friend of mine. Actually, he's my neighbor. But he's an expert in PR. He worked for a very large PR firm, and he set up on his own most recently. So I thought it would be very interesting to invite him to speak about his experience, his plans, and to give us a different perspective from the other speakers in the last few weeks. So without further ado, over to Andrew.
Jacob, thanks very much. I hope you don't mind if I take my jacket off. It's a bit hot here. This is not going to be death by PowerPoint. I haven't got any slides, so I hope that's a relief to you. I also hope that you will ask me questions, because I'm not sure I've got enough to say to fill the whole 40 minutes by myself, and also I think it's more interesting for you guys if you ask questions and you have a say in what I talk about, because I don't know what you don't know, and I'll only know what interests you if you show me by asking interesting, I hope, challenging questions. And don't feel embarrassed at all about asking me difficult ones, or ones you think might embarrass me. I'm used to it. I thought of entitling this talk "The Accidental Entrepreneur," because when I was your age, the last thing I would have thought of doing would be running my own business. I studied humanities, studied languages at university. I was interested in politics and literature, and not unless in this order, but finding a girlfriend. Not only was business the last thing on my mind, but also I had very little understanding of what business involved. As far as I was concerned, making money was irrelevant, boring, uninteresting, intellectually unchallenging compared with what other things I might do. And having played around at journalism at university, I edited my university magazine. I found myself on the night train, because in those days there wasn't a Eurostar to Brussels, place I'd never been to before, to start working as a journalist on a local magazine. I think one of the interesting things when I look back on it is I think of myself as being very risk averse, but actually somebody at the time pointed out to me that leaving the country you've grown up in, going somewhere completely different where you hadn't been before, being willing to start a career in a country you don't know with people you don't know is actually quite a big leap in the dark. It didn't seem to me like that at the time. But I was very lucky, because at the time I landed in Brussels at a time when the what was then called the European Communities, now called the European Union, was going through a very interesting stage of its development. A gentleman called Jacques Delors, who was a former French finance minister, had just become president of the European Commission, and he and some of the other commissioners came up with this idea of giving new impetus to the European Communities it then was by creating the single market, which is funnily very relevant now, because with Brexit we're now looking very closely at what being a member of the single market actually means, and what withdrawing from the single market might mean for the UK and other countries. So I found myself in my early 20s following around some really big beasts in the political jungle. People like Helmut Kohl, who was the architect of German reunification, Ronald Reagan, who was one of the players in the end of the Cold War, Margaret Thatcher, of course, everyone knows. So it was quite an interesting time, and exciting time to be a journalist. So my knowledge and interest in business came very much by accident, because as it happened, having been in Brussels for a couple of years, getting on for 4, I was looking for another challenge, and it was suggested to me that I might like to get involved in business journalism. So I found myself again having to get on a train, pack all my things and go to somewhere I'd never been before, In this case, it was the city of Edinburgh, where I went to work on the Scotsman newspaper. From then on, I had I think something like 10 years in business journalism, covering mergers and acquisitions, corporate activity, IPOs, the ups and downs of share prices, no end of corporate scandals. During that time, I ended up working on the business pages of the Evening Standard. Again, it was a pre-internet age when the 11 o'clock edition of the Evening Standard was the first chance that people working in the City of London had to get a sense of what was going on in terms of that morning's company announcements. So it will be a daily diet of results for corporate earnings, big M&A stories. And it culminated with what at the time was the biggest corporate collapse for many years, which was the collapse of Bearings as a result of a trader called Nick Leeson in Singapore gambling the bank's money on the Nikkei index derivatives, and that going badly wrong. Some of you may have seen the film that was made subsequently, not the greatest film, but gets the gist. As it happens, it was really a foretaste of what we actually saw in the 2008 crisis, when it wasn't just one big investment bank going bust, but practically everyone in danger of doing the same. So it was a baptism of fire, and it taught me a lot very quickly. There came a point in my career when I started to think, well, I could do this in my sleep, and I needed to change. And I was approached sometime later to go and work for a big corporate communications consultancy called Brunswick, which some of you may have heard of. They look after about a third of the FTSE 100 index, look after some major US corporates, are increasingly active in the Middle East, China, South Africa, and they are often called in by investment banks or lawyers to help companies that have specific problems, whether it might be an M&A situation, a new listing, problems with investors, activism, corporate crises, regulatory investigations, all sorts of things which are likely to impact on the company's share price, lead to clashes with politicians, media and other regulators, and put the organisation very uncomfortably in the spotlight. It was a limited liability partnership, and after being there a couple of years I was promoted to partner, and in a sense I was in some senses an entrepreneur in a sense that I had an equity stake in the business and was involved in management decisions, in marketing decisions, in managing people and allocating resources. The trouble with working in a big organisation is you take a lot for granted, and you have to toe the line, you have to explain what you're doing to other people who don't necessarily understand where you're coming from and why. And having done that job for, in this case, it was more than 50 years, I was starting to feel that same old feeling that I'd done this many times before. I knew what I wasn't really learning anything, I wasn't challenging myself, I wasn't stretched. I also felt increasingly that the organisation had changed, wasn't quite the organisation I joined, that increasingly the business was becoming a bit sclerotic. People who were managing the business were coming increasingly remote from the sharp end of the business, and were putting pressure on people like me to do things that we felt were actually damaging to the business or were interfering with our client relationships, and meant we weren't doing the kind of business that we wanted to do or were comfortable doing, or indeed felt our clients wanted from us. So I took the decision after some long thought and talking to people I knew, sounding out the market, getting a feel for what people might want, might not want, what they might be willing to pay, to set up my own company and to leave the comfort of a large organisation. At the time, it felt like a quite a big leap in the dark. Fortunately, there was one client that did say that they might come with me, but one never knows. People say all sorts of things in these situations. And somebody once said to me when I was contemplating this, "You'll be surprised how many people will say nice things to you, promise to give you business, who won't come through when the chips are down, and people who you don't least expect who actually do come through and call you up and offer you work." And so it is proved. I'm now just over a year into my business. I have more clients and more referrals than I expected at this point, and having started off thinking, well, as long as I can pay the rent and have a little bit of freedom to do things the way I wanted to do them, that would be fine. Now I'm having to think about, well, is this how I want things to be? Am I doing the right kind of work? Have I got the right mix of clients? Do I need to think about bringing on other people? How scalable is my business? How far do I want to go? So these are all nice questions to have. But as I say, it's an interesting place to be. It's also been interesting because, as I said, I've spent a lot of time advising other businesses, albeit from the narrow focus of people's reputation, communications, investor relations, and that sort of thing, rather than the whole gamut of business operations. But I've seen how people have operated, how they've faced up to their challenges, how they've dealt with certain situations. So I was very interested to have the opportunity, albeit in a small way, to try and see if I had learnt anything, if any of the lessons I'd learnt did apply. A couple of things I did take away was stick to what you know. I think people get into an awful lot of difficulty if they try and do things that they don't understand. Keep it very simple. I think complexity is always a huge enemy of businesses, and trying to do too much at once or trying to take on more than you can cope with is a big challenge for a lot of businesses. And I've learned by experience that often a very difficult time for a business isn't so much when they're chugging along at a reasonable clip, but when they try and expand too quickly. And the other thing I learned was keep your costs down. Don't spend too much before you know how much you can earn, how much you can afford. I know other people in the similar field who've launched startups who've taken the view that they need a certain size, they need to have a certain infrastructure and capability in order to be able to get the kind of business they want to do. Of course, there are arguments for that, but for me the problem with that is that you wake up every morning knowing that you have to bring in a certain amount of revenue without knowing that you are going to be able to bring that amount of revenue, and you don't leave yourself much margin for error if things go wrong. And again, one of the things I have learned from watching how other people have operated in the business world is you can sit and strategize however much you like, but you don't know until you actually get out there into the marketplace what people will actually buy, what people actually want, which of your services they are actually going to accept, whether your pricing's right, whether your product is right. So you have to be prepared to be flexible, to change direction very quickly, but also to recognise that sometimes things are going to take time and going to take longer than you expect. I don't know how much of you know anything about the field I operate in, and it might be worth, I think, spending a bit of time explaining what, when I talk about communications or people talk about public relations, they mean. Because it's one of those things that if you're deep in the business like I am, a lot of this seems very obvious, but now and again you realise that to people who haven't had the experience that I've had, a lot of this comes over as mumbo jumbo, and doesn't make a lot of sense to people. When I was thinking of moving across from journalism into communications, I had a conversation with someone I knew very well who was a good contact of mine, and gave me quite a few some very interesting insights into some situations in which he was operating. He was a banker, an M&A advisor at the time. His name is John Cryan, and he's now chief executive of Deutsche Bank, which, as many of you may know, is an institution that is going through an awful lot of pain and having to restructure and rethink very fundamentally what business it's in and why. And I sort of went in expecting him to tell me that communications is not that interesting compared with some of the other challenges that businesses face. And he said to me something very interesting, which I found quite inspiring, which was that communications is ultimately the most important thing in any business. Whether you're worried about, you're a public company, you're worried about your share price, what moves the share price isn't your earnings, it isn't your M&A, it's how you communicate those things. It's the actual way that information is received and understood by the market that moves the share price. And knowing how to manage that flow of information properly, professionally, and to your best advantage is a very, very important task and very important skill. Likewise, when you're trying to sell your product, raise money, you name it, again, it's all very well having the best possible product or the best possible service, unless you can actually get that information to your ultimate consumer or ultimate investor in a form that they understand and can appreciate. You can have the best product in the world and it doesn't do you any good. So that made me think that actually being able to understand how to communicate, understand how to explain things, express things, present things, understand how people listen to them, what they hear, the fact that people hear what they want to hear and don't necessarily hear what you say, is a very, very important skill, and one that I realised over time that not everybody has. So what I do as part of my job is, I sit down with people who need to communicate. It may be because they're trying to sell something, maybe they're trying to raise capital, it may be because they want some recognition, and trying to help them understand what they need to do. Sometimes it may be something very simple, like thinking about how they tell their story. It may be who they tell the story to. It may be because there are difficult issues that they are having to handle and they're having to communicate about, in which case they need to think very seriously about what they ought to be saying in order to calm people down, reassure people, convince people that they have the issue under control. And again, it's about knowing when and where to talk, when and where, who and where, who to speak to, when and how. And then there is the very important issue that increasingly people need to think about how they behave and their conduct, because people talk about body language, but how you behave and how you conduct yourself is a very important way of signalling to people in the outside world what you believe in, what your values are, and how you want to be perceived. So, very often I'm called into situations where people haven't really decided yet whether they want to communicate, who they want to communicate, how they want to communicate to, and part of what I'm doing with people is getting them to understand that they need to think very carefully about how their conduct will be interpreted and perceived, and how it will impact on their reputation, on their brand, and sometimes on their share price. So that's briefly what I do. As things stand at the moment, I have a portfolio of around, I have a portfolio of 5 clients who pay me a regular monthly amount, which is very good for me because it gives me a certain amount of certainty, and on top of that I have a network of people who come to me because they have specific issues, and those are kind of more short-term projects which I undertake in return for a fee. It's life of an entrepreneur is always unpredictable. That can be good because you can get some nice surprises, but it also can be unpredictable in a bad way, in that things don't work out and you realise that you're only as good as the next paycheck. Working as I do on my own without the infrastructure of a big organisation also has its challenges. It means that I have to think very carefully how I spend my money. When I was working for a big organisation, somebody was always there to pay the airfares, pay the restaurant bills, and as long as I remembered to fill in my expenses form correctly, it got reimbursed. Now I have to think very carefully how I spend the money. Is it a worthwhile investment? What will the return be? I also have to make the decisions myself. There's nobody around to tell me I have to do X, Y and Z today. I don't have to fill any forms. If I feel I have to work and I have to work till 2 o'clock in the morning, I work till 2 o'clock in the morning. If there's nothing much going on and my clients are fairly happy, I can go to the gym, and that's great. But it's not for everybody, and I know a lot of people who are in my situation who think I'd rather have the certainty that somebody else is paying my salary every month, and that I don't have to worry where the next client is coming. But that is the life of an entrepreneur. As I said, I've taken the choice at this stage anyway that I don't want the responsibility of employing other people, and I'm very fortunate that the business that I work in and the business model I've chosen is very much a one-to-one business where you're effectively selling your own skills, your own expertise, your own knowledge, your own experience. It would be very different if, just for the sake of example, I was trying to manufacture a car that I certainly couldn't do on my own. If I wanted to do it on a bespoke basis, I'd still need a team of people who could have the skills necessary. I'd have to manage them, I'd have to pay their salaries, I'd have to think about the marketing, I'd have to think about the safety. At the moment I only have to think about myself, which is a luxury, which may not last. Anyway, I think I've talked for long enough. I don't know, I'm sure you must have some questions. If not, I can make some up.
Let me ask you, thank you for the presentation. With the fintech boom, do you think finance is still like a very, not a crowded market right now to start a business?
So can you repeat the question? With the tech boom?
Fintech boom.
Yeah.
You think that finance and services connected to them is still like very profitable as a industry to start a business, or right now it's quite difficult to start?
Well, I mean, there definitely is. Partly because of the regulatory pressure we've seen since the crisis of 2008. I think there is there's a deliberate attempt by the regulators in many markets, UK for example, US, to reduce the amount of money that is being made in financial services. One of my clients, for example, started a business a couple of years ago which is offering unconnected, unconflicted research to buy-side investors. And because of MiFID II, which is the regulation which has been introduced throughout the European Union, and a similar regulation is being adopted in the United States, cross-subsidization of research by broking houses is no longer possible. So, the buy side traditionally got reports on companies and sectors for free in return for agreeing to put some of their trading revenues with that particular investment bank or broking house. Now are going to have to pay for that. So there's a huge shakeout, and he was saying, well, the budgets seem to have been cut by anything between 50 and 80% for research. So, I mean, this is just an example in microcosm of what's happening. You know, the traditional research analysts who work for a broking firm, you know, you might cover banking or tech or pharmaceuticals, would have been earning, you know, $500,000 basic plus maybe 2 or 3 times bonus, probably cost 2 or 3 times as much in terms of the infrastructure needed to support that person. You know, now the revenue that person can generate is being cut by 50 to 80%, and that is going to have a huge impact.
Do you think that this is due by the regulation and SEC not following it? So you think this is going to move more to the United States because it's more open market?
Well, no, I'm saying the SEC, I can't remember the exact name of the regulation they've introduced, but it's a very similar regulation. So I just use that as an example of an area which used to be very profitable, where there are opportunities for employment, that, you know, very remunerative employment, which are disappearing. I mean, competition is also cutting the margins that asset managers can charge for managing people's money. Low interest rates have been reducing returns that financial services can make through investment. So there are a huge number of areas in financial services where the revenue is being shrunk, and at the same time the cost of regulation is going up because regulations become more onerous, compliance has become more onerous. So, you know, a lot of banks, for example, are having to invest hundreds of millions of dollars just producing people who follow what other people are doing and have to check on it and submit reports to the regulators. So that's an extra area of cost. Banks also have to carry much more capital than they did prior to the crisis. So all of that is forcing them to look much more rigorously at cost. There's been another phenomenon which goes alongside it, which is that the trading revenues have slumped because volumes have gone down. So again, that's cut revenue and profitability in these big firms. So all of these pressures are forcing them to cut costs, push people out of the industry, particularly more expensive people out of the industry, and is reducing employment opportunities. That said, you know, compared with many other professions, it's still quite attractive. But I think there is certainly we've seen in a number of countries, a lot of people are sort of people coming into the workforce for the first time, who may previously have gone into financial services, particularly to high-end financial services, investment banking, broking, etc., are now being attracted to tech because the salaries are higher, the opportunities are there, and it's also more glamorous at the moment than financial services. So yeah, I mean, I think there is a phenomenon going on where tech has become much more attractive as a place to work than financial services.
Can you talk a little bit about scalability of the business? At the moment, you had your first year, you have a nice business, you have cash flows. We like to see cash flows as a finance guy. But what's the scalability? How big can this be?
It's a very interesting question. It's one of the questions that I'm asking myself. And I think it's a sort of challenge. The sector that I come from is very much a people business. One of the things that struck me and was part of my thinking when I set up my business was a lot of clients complain, not just about communications advisors, but professional services generally, that they often hire a firm on the basis of confidence in a particular individual who they may have worked with before, who has the requisite skills and expertise, and then they find that the once the initial sale has been done, that they then hand over to somebody more junior, who maybe doesn't have the same depth of experience, the same rapport, maybe they don't feel the same kind of confidence or trust in them. So part of my pitch to people was, since you've just got me, there's nobody I can then hand on to. So if you're hiring the firm for me, then you're getting me. The trouble with that, of course, is it's not scalable, at least in the narrow sense. Now, the way some firms in the sector deal with that is that they maybe start as partnerships, groups of 2 or 3 people who very much like mind and, you know, almost interchangeable. And because they're still quite small, it's a lot easier to go to clients and say, you know, here's Tom, here's Elizabeth, we started a business together, we share the same values, we share the same thoughts. But of course it still limits how much work you can do. So there is a very big decision that has to be made, and a trade-off. If you want to keep your margins high, then the classic way that people in the industry do that is they bring in younger, less experienced people, and they try and parcel up the work so that the young, less experienced people can do more of the execution and more of the labour-intensive work, and that the senior level, or its partners, the MDs or whatever, will focus on high value added, maintaining the client relationships, being wheeled out in sort of very critical situations where they can demonstrate real value, and then they hand over to a team of younger, cheaper people, and yet they still charge the same fees as they would do if they were doing the work themselves. The trouble is there's a certain amount of sleight of hand and dishonesty, in my view, in doing that. So there may be an alternative path, which is to say, let's bring in people as and when there's specific tasks which really do need people with a different skill or a different level of expertise, or else concentrate on very much the high value added stuff where you can deploy experienced people and charge accordingly. I don't know what the answer is, and I may not know the answer. And it'd be interesting, maybe when I come back in a year or two, I will have found the answer.
It's interesting because there are other similar businesses, such as lawyers, such as investment bankers, such as advertising agencies, who all have a similar issue in that how can you kind of bridge that issue of providing a very personal service and then growing it and making sure that you create value.
One of the big, on that point, I mean, one of the big trends in the last couple of years in investment banking has been the growth of advisory boutiques. And they pitch themselves again as you have people with experience, with judgment, with relationships, who can charge really high fees just for giving trusted advice. And the pitches, because they don't have conflicts of interest that some of the big investment banks have, they're actually giving genuine advice, they understand the business, they don't have an incentive to try and push management companies to do things which are not in their interests. Whereas the big investment banks, once they reach a certain size, they can only make their money and make adequate returns by bringing in additional revenue streams. So it's not enough just to have won the business advising a company on a transaction. You then have to sell in the debt, you have to sell in the bond issue, you have to sell in an equity issue, you have to persuade the company they need to hedge their position and charge another team for the derivative position. And before you know it, the company is no longer sure whether they're being told to do these things because it's really advantageous to do them, or because the bank advising them needs to maximise revenue. So, I think there is a big problem that a lot of these businesses have, that they want to be able to follow the client and provide the full range of services to the client. But once you've got somebody who can do, who can do a Japanese Nikkei bond, and you've got somebody who can manage a derivative exposure. You've got somebody who can syndicate debt. All these people need to be fed, and then that creates pressure to bring in revenue irrespective of whether there's a real client needs. And this creates huge dyssynergies, which mean that some of these businesses build themselves up and then start to fall apart as their businesses become competed away, unbundled, or disaggregated.
Any questions? Yes.
No, I just have a question in terms of reputation management. What advice would you give to Facebook considering the data leak this week and the whole ordeal with Cambridge Analytica?
Well, apart from advising to hire me,
Have they phoned you? Have they called you?
I mean, it's a very interesting one because I mean, one of the things about the way reputations work is things do go in cycles. I mean, what often happens is that companies become extraordinarily popular and extraordinarily successful, and then suddenly it flips. I mean, here in the UK, there's the phenomenon of Tesco's. If you go back far enough, Tesco could do no wrong. Alan Layton, who was the CEO, was an absolute superstar. The share price hit the roof, and then it all kind of started to unravel, and it all seemed to unravel in different places all at once. You know, they found themselves sort of up against the limits of what they could do from a monopoly point of view. They were finding, you know, their superstores were cannibalising each other. Margins were coming under pressure. They tried to diversify internationally and then found the margins weren't there. They tried to diversify into catering and that didn't work. The share price started to collapse and the government started getting upset. People started complaining about, you know, the way Tesco's treated their suppliers, particularly farmers. So it all kind of crowded in on them. So I mean, I think what you're seeing with Facebook is something very similar. It went through a period when everybody was on Facebook, everybody liked it, it was a great way of staying in touch with people. And then they kind of got too big. Now whether it's, I mean, people talk statistically about reversion to the mean in terms of financial markets, you know, whether there is just a phenomenon, whether it's about how public opinion works, that the public opinion kind of goes in cycles of overcorrections. And maybe that's how markets work as well, that, you know, in the same way that human beings kind of get terribly excited and then go too far one way and then they have to correct. And whether it's the organisation itself reaches a certain size where it stops talking to the outside world and starts to become very internally focused. I mean, there is certainly a phenomenon about size. I mean, we don't like people who are too big. You know, we have the expression English, too big for their boots. And some of it's also culturally specific. I think it's interesting that in Europe, resistance to Facebook is much stronger and it's become earlier than the United States, and that's obviously a culturally specific thing. I think Europeans tend to be much more suspicious of success and size, and more willing to, there's what they call the tall poppy syndrome. The more people stand out and stand up, the more it creates envy and people wanting to bring them down. So, that, how to answer your question? I think Facebook, I mean, one of the first things you need is, when you're being attacked by people, is a bit of humility, which I think is very difficult for them as culturally. You know, humility means showing that you're willing to listen. It means rather than necessarily telling people you're wrong, it means saying, okay, we realise there's a problem, we want to talk to you, we want to find out more about what you're worried about and how we can deal with it. Where things start to become difficult for all companies in this situation is there may start to be an obvious conflict between the needs of managing your reputation and your business model. And I think part of Facebook's problems have come from trying to commercialise and monetize their reach, and one of the things that is I think is more acceptable socially is when they were seen as being a purely social network and weren't being driven for profit. Now that people are aware that they're trying to sell advertising, that's that's sort of put them in a different category. There was an article today in the Times by one of the commentators that was talking about this sort of latest issue with Cambridge Analytica, and just pointing out that some of what's acceptable in terms of sort of an advertising model and a sales model no longer is accepted when you move into the political sphere, for example. So I think there's a very big issues with Facebook having to understand a little bit about what's socially acceptable in different spheres of operation, and having to adjust itself. I think the other thing is that you've also got to look at where you are creating enemies, and look at whether you need to carry on creating those enemies, or whether you can do something to deal, category by category with those enemies. Going back to the Tesco's example, there were issues around farmers and suppliers, and those were over time they were able to address some of those by coming up with initiatives that managed to identify where they could change their practices to make them more acceptable without doing huge damage to their commercial operations. I think in Facebook's case, bearing in mind that reputation is driven to some extent by the media, but not as much as it was, but also the links between the conventional media and the political world. Facebook have made made a lot of enemies in the media, partly by becoming a competitor in terms of becoming a source of news that competes with conventional media, but also more seriously in undermining the business model of conventional media, because they and Google have sucked in a huge amount of advertising revenue, which many publishing houses they were hoping. I mean, they were aware that there was a migration from print to the internet, but they thought that they could continue to capture that. And you had the situation where newspapers like The Guardian went to a free model on the internet, assuming that they would then bring in enough eyeballs to then justify earning more advertising, but that never happened. So I mean, there are issues about the revenue sharing model with Facebook. There's also, in fact, I put this point to Nicola Mendelsohn, who's head of Facebook Europe at an open meeting. One of the founders of Twitter, partly in kind of out of penance for having created this medium which reduces everything to 140 words, has founded this platform called Medium, which publishes long-form journalism. One of the things I suggest is one of the things that Facebook could look at is how they could deal with both that issue and the issue I talked about undermining the revenue model, but also in terms of the whole fake news issue. Is one of the things they could look at would be maybe they should set up some kind of foundation that would sponsor or fund responsible journalism, or public service journalism. They also obviously need to start showing that they take responsibility. And again, one of the criticisms is that they've presented themselves just as a platform rather than as a publisher, and actually they are serving as a publisher. And in the same way that we've always thought that, if you set yourself up, going back to Gutenberg with the establishment of the printing press, once you acquire the ability to disseminate information, you have to take some responsibility for the accuracy of that information, take some responsibility. In wartime, newspaper publishers had to submit to censorship and so on. There is a feeling in our society, even among societies that value the freedom of expression, freedom of the press and freedom of media, that there are certain social norms and social standards which override the right of free expression. So platforms like Facebook need to be doing more to show that they accept that they have now assumed that role and accept the responsibilities that go with it.
Thank you very much.
Any other questions? No? I think we can wrap it up. Thank you very much. It was a fascinating talk. Thank you very much for giving us some insight into communications, PR, into the world of advising companies, and also your own journey. And I wish you best of luck.
Thank you. If any of you want to get in touch to ask questions you're too shy to ask, by all means, I have some cards here, and I'm happy to respond by email if it's of interest.